Welcome to my channel. Time for Bitcoin.
So there is an expression, Warren Buffett's used it, is when the tide goes out, you see who's swimming naked. So the tide out in this is liquidity. And liquidity is driven by central banks trying to stop inflation. So they raise interest rates when they think there's inflation. It slows down the economy. It's harder to borrow money. The whole economy slows down and we restart. It's called the business cycle. And you and I have talked about this in the past. So the economies are cyclical. They're naturally cyclical because the credit cycle, even without central banks, is you kind of lend or borrow too much money, then something happens at the margin and you're like, oh shit, I borrowed or lent too much money, and you pull it all back again and then you do it again, right? So the central banks try and soften that cycle, but they still create it and use it to try and not let economies go too far, like hyperinflation or depression, whatever it is, right? So that's what they're trying to do. That cycle drives the movement of asset prices. And so that's the stock market, the bond market, equity market, the currency market, the crypto market. And with that cycle becomes the human emotion cycle. And the human emotion cycle is, I'm making a fortune, I'm a genius, I can never go wrong, I'm going to be rich, extrapolate. Future vision of myself is now going to be driving a Lambo and, etc. And if you think about it, and that's exactly what happens to all of us, and we have to fight that demon, is you start extrapolating out and you start thinking, my vision of my future self has now been ratcheted up. So investments are just a manifestation of your future self, right? That's what we're trying to do. So you got that vision of what you'd like to be, and to get there, you invest because that will deliver that. So if your investments do well, you start stupidly readjusting yourself higher all the time. So then what happens is when the market goes against you, you have to go through the emotional inner journey of, oh, maybe I won't get there, right? That's really hard for people. It's emotionally really hard to kind of plant a flag on that's what my future is definitely going to be, definitely, because I'm really good at this investment game, to I was completely wrong. And what happens is you then over extrapolate on the downside. If this continues, crypto is going to zero, all of my savings that I've been dollar cost averaging, listening to Tom and Raoul, it's all bullshit. This has been a scam. It's the exact opposite. But when you step back, you take a nice logarithmic chart of Bitcoin, and anybody can do that in TradingView or any of those charting things, and it's a nice, smooth, upward trend, which is the adoption of cryptocurrencies and blockchain technologies as a new financial system and a way of exchanging value on the internet. In the middle of that, on a log chart, it just looks like it slowly does that. On a linear chart, it looks like this. But no, it looks like, more correct, it does this, collapse. And what happens is everybody goes, when it goes up on a linear chart, everyone goes, it's a bubble. People who aren't involved. Then we all get to the over extrapolation of like, we're all going to be billionaires, let's order my Lambo. Then it starts coming down, it's denial, typical, the human phases of emotion. And then you get to anger and despair, which is where we are now. But that whole story of humanity, liquidity, central banks is all within this long, smooth uptrend that keeps going. And people forget it. They forget it at the bottom and they forget it at the top. And it's as simple as that. So to go back to what you were suggesting, has anything changed in the crypto market? Not a thing. Is the technology being utilized? Has Solana just agreed to use their blockchain with Meta for NFTs? Yes. Are Google working with Solana? Yes. Is Ethereum being built out? Did DeFi fail? No. Does the decentralized financial system idea work? Yes. Are cryptocurrencies being exchanged in a value system on the internet? Yes. Is the number of people growing in that ecosystem? Not a lot, because it's stabilized. But if you look at the past cycle, so the 2017 peak to the low in 2019, we lost about 80% of the active wallet addresses. Wow. When I look at it now, we've lost about 30 because the adoption keeps rising. So it really is a psychological game. And it's a long-term game because, and you've talked about this, is we're not involved because we can make money over a 1 year time or a 2 year time. We're saying, listen, the bet here is if you hold on and if you add at the bottom of the panic cycle and just keep holding and don't use leverage and just be sensible about what you're doing and don't keep checking the market every day, the probability of you coming in at the end of the decade and having manifested your future self in a way that probably might be quite unexpected. And if you do that, you won't go through that emotional journey.
Raoul Pal is the CEO and co-founder of Real Vision and the CEO and publisher of the Global Macro Investor. He was co-manager of GLG's global hedge fund in London. He was one of the few investors to predict the 2008 mortgage crisis. In this episode, he touches on very important topics such as inflation, currency depreciation, and money supply. It's not as simple as it sounds. It's a very complex subject, and most people still don't understand these mechanisms.
So quantitative easing is a way of saying we're going to debase the money. But you'll see it on Twitter, people say, well, it's not debasement because, and they talk about some mechanism. The net effect is the same because they had too much debt. What the hell do we do with too much debt? You either have a massive inflation or you debase your currency. The Roman emperors used to clip the corners off the coins. And in fact, anybody who's ever used gold as a system of money has always debased their money by clipping the edges off. At first you don't notice because they take 3% off. And then before you know it, they're just cutting them in half and saying, well, there you go, it's the same. And then the empire collapses. It's just that story.
What?
It's several thousand years old. This is where everybody got this wrong, and I've been bleating on about this forever. Inflation is a generalized rise in prices. The price of eggs goes up, the price of gas in your car goes up, the cost of employing people goes up, etc. Debasement of currency is this really weird little trick. Things of fixed supply or relatively fixed supply go up immensely, optically, because the price of the currency's fallen. Things of variable supply, like wages, corporate earnings, don't, and they don't go as much. So what you find is, after quantitative easing, what happens? Stock market goes up, gold goes up, cryptocurrencies go up, housing goes up, fine art goes up, all of that stuff. Assets. So assets are a way of storing wealth. That's what an asset really is. So in relative terms, they've held their price and the currency's fallen, makes them look like they've gone up in price. It's not. And this is what everybody gets confused with. This is why price earnings ratios have gone up so much, because the earnings doesn't move as much as the price of the asset because it's a small fraction of it. So PEs keep going up the more we debase currency. If you want to see another example, you look at a chart of the Venezuelan stock market in Venezuelan bolivars, and it goes straight up. If you put it in US dollars, it's actually down 99%. So it doesn't create a generalized rise in prices. This is what everybody confused, because they thought it was an increase in the money supply in a way that you and I could get it, we can go buy more stuff. It doesn't work that way. I don't believe inflation is always and everywhere a monetary phenomena. It is a supply-demand phenomena above all things. Some people claim it's a supply and demand for money phenomena. I don't believe that, because of the 1970s inflation is as provable as it possibly can be, was driven by demographics. The baby boomers all hit 30 at the same time, bought their first house, their first car, their first blah, 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 blah. And that's what caused the inflation of the 70s. We've never had inflation like that before or since, because guess what? We've never had such a big cohort of 25 to 30-year-olds all at the same time. So what you have is massive
things that have a limited supply.
Correct. Or buy anything, because they used to live with their parents, and before you know it, they're buying duplicate stuff. Because you live with your parents, there's one car or two cars, whatever it is, right? You leave, there's now another car. And you meet a girlfriend or a partner, there's another car. So you've now doubled the and you bought a house. So that's a second house that didn't exist before. That's why demographics are deflationary and inflationary, depending where you are in the demographic cycle.
What do you think about what awaits us in the near future? Will the markets pick up or will we face a long recession? Let me know in the comments what you think. Thank you for staying until the end. Please like and subscribe if you appreciate my work.